Ladies and gentlemen, what if I told you that the biggest story in the precious metals market isn't the price of gold, it's who may be controlling the supply? Reports and speculation are swirling that Trump's Treasury has taken decisive action involving Comex gold and silver. Is this a strategic move to protect America's financial future, or is something much bigger unfolding behind the scenes? Today, we're separating facts from speculation, following the money, and uncovering why this story could matter to every investor, every saver, and anyone watching the global financial system. For decades, one of the biggest misconceptions in the precious metals market has been the belief that the price of gold and silver is determined solely by buyers and sellers exchanging physical metal. That's a logical assumption, but it's not how the modern market actually works. The global benchmark prices most investors watch every day are influenced primarily by futures trading, where contracts representing gold and silver change hands in enormous volumes. Understanding that distinction is the first step toward understanding why Comex plays such an influential role in the precious metals ecosystem. Comex serves as one of the world's major futures exchanges for gold and silver contracts. The vast majority of activity taking place there isn't about someone showing up with a truck to collect bars of gold or pallets of silver. Instead, participants trade standardized contracts that represent future delivery of metal. Many of these contracts are opened and closed before delivery ever becomes necessary. In other words, they're financial instruments used for hedging, speculation, and managing risk. This creates an important reality that often surprises new investors. On many trading days, the amount of gold and silver represented by paper contracts can exceed the amount of physical metal that actually changes hands by an enormous margin. That doesn't automatically indicate anything improper. Futures markets exist to provide liquidity and allow producers, refiners, manufacturers, and investors to manage price risk efficiently. But it also means that short-term price movements are often driven more by financial positioning than by someone physically buying or selling bullion. Another point that deserves attention is who participates in these markets. The marketplace isn't controlled by one individual or one institution. It includes commercial hedgers such as mining companies, large financial institutions acting as market makers, investment funds, proprietary trading firms, institutional investors, and government-regulated clearing organizations. Each group has different objectives. A mining company may sell futures contracts to lock in revenue months before production. A manufacturer may purchase contracts to secure future supply. Investment funds may take positions based on macroeconomic expectations, while short-term traders react to economic data, interest rate announcements, or shifts in market sentiment. Large financial institutions naturally attract attention because they often hold significant long and short positions. Their size allows them to provide liquidity that keeps the market functioning smoothly. However, their presence also fuels ongoing debate among precious metals analysts regarding how much influence concentrated positions may have on short-term pricing. Regulators monitor these markets with reporting requirements and position limits intended to promote orderly trading, though opinions differ on how effective those safeguards are. Another layer involves the exchange itself. Comex establishes the contract specifications, delivery procedures, margin requirements, and warehouse standards. It does not set the price by decree. Prices emerge through continuous buying and selling among thousands of market participants. Yet, because such a large share of global price discovery occurs through these futures contracts, actions affecting trading conditions, such as changes in margin requirements or shifts in market liquidity, can influence price behavior, even if the supply of physical metal hasn't changed significantly. Physical inventories also deserve careful consideration. Approved vaults store metal that meets exchange specifications, but not every ounce in those vaults is necessarily available for immediate delivery against futures contracts. Some inventories belong to private owners who simply choose to store their bullion there. Other inventories are designated for potential delivery. Understanding the distinction between stored metal and deliverable metal is important because headlines sometimes blur these categories, leading to exaggerated conclusions. When markets become volatile, investors often focus on delivery activity. They ask how many contract holders actually stand for delivery instead of settling financially. During periods of heightened uncertainty, stronger demand for physical delivery can become an important indicator of investor confidence. It may suggest that some participants prefer holding actual bullion rather than simply maintaining exposure through paper contracts. Even then, delivery requests should be viewed within the broader context of market operations rather than interpreted as proof of systemic failure. Macroeconomic forces often exert an even greater influence on precious metals than daily trading dynamics. Inflation expectations, central bank policies, real interest rates, currency movements, geopolitical tensions, and sovereign debt concerns all shape investor demand for gold and silver. These broader factors frequently determine long-term trends. While futures market positioning can amplify short-term volatility, silver deserves special attention because it combines monetary characteristics with substantial industrial demand. Unlike gold, which is held primarily as a store of wealth, silver is consumed in electronics, solar technology, medical applications, and numerous manufacturing processes. That dual role can make silver especially volatile. Changes in industrial demand, investor sentiment, or supply constraints may all interact simultaneously, producing price swings that are often much larger than those seen in gold. For long-term investors, perhaps the most valuable lesson is recognizing the difference between price discovery and intrinsic value. Futures prices fluctuate minute by minute based on countless financial decisions. Physical bullion, however, represents a tangible asset with no counterparty risk when owned directly. Many precious metals advocates emphasize this distinction, arguing that while paper markets influence quoted prices, the underlying appeal of physical gold and silver lies in their historical role as stores of value during periods of economic uncertainty. Ultimately, no single entity controls Comex gold and silver in the simplistic sense often suggested by headlines. Prices emerge from the interaction of diverse participants operating within a regulated futures marketplace shaped by global economic forces. Large institutions, exchange rules, market liquidity, investor psychology, and physical supply all play meaningful roles. The key for investors is not to assume that every price movement reflects changes in physical demand alone, but to understand that today's precious metals markets operate through a complex blend of financial instruments and real-world fundamentals. Those who appreciate both sides of that equation are generally better equipped to interpret market signals and make informed, long-term investment decisions. Whenever governments become more interested in strategic assets, it's worth asking a simple question: what problem are they trying to solve? History shows that governments rarely increase their attention on critical financial markets without a broader economic or national interest in mind. Whether the issue is energy, agriculture, rare earth minerals, or precious metals, the motivation is usually connected to stability, security, or preparation for future uncertainty. That's why discussions about greater government interest in gold and silver markets continue to attract so much attention. One of the most obvious reasons would be the growing burden of national debt. As government borrowing increases over time, maintaining confidence in the financial system becomes increasingly important. Investors around the world constantly evaluate whether governments can continue servicing their obligations while maintaining economic growth. During periods when debt reaches historically elevated levels, markets often become more sensitive to inflation, interest rates, and the long-term purchasing power of currency. Gold has historically served as a financial barometer during these periods. When confidence in paper assets weakens, investors frequently seek tangible stores of value. Gold doesn't generate income, but it also carries no default risk when held physically. It has survived wars, recessions, banking crises, and monetary reforms across thousands of years. That history explains why many central banks continue to maintain substantial gold reserves despite the modern financial system relying primarily on fiat currencies. Another factor involves the strength and credibility of the US dollar. The dollar remains the world's dominant reserve currency, facilitating international trade, investment, and global finance. Preserving confidence in that system is a strategic priority because it provides significant economic advantages. Any development that raises questions about monetary stability naturally attracts the attention of policymakers. At the same time, global financial conditions are changing. Numerous central banks have increased their gold purchases in recent years as part of broader reserve diversification strategies. Rather than relying exclusively on foreign currencies or government bonds, many nations have expanded their gold holdings. These decisions are generally viewed as long-term portfolio management rather than short-term speculation. Still, the trend reflects a growing appreciation for assets that exist outside the credit system. Inflation also plays a central role in this discussion. Rising consumer prices reduce purchasing power, affecting households, businesses, and governments alike. Central banks attempt to manage inflation primarily through monetary policy, including adjustments to interest rates. Yet inflation expectations often influence investor behavior well before official data fully captures changing conditions. Gold has historically been viewed as one possible hedge against prolonged inflation, although its performance can vary significantly depending on interest rates and broader economic conditions. Silver introduces an additional dimension because it functions as both a monetary metal and an industrial commodity. Demand for silver increasingly depends on manufacturing, renewable energy technologies, electronics, medical applications, and advanced industrial processes. As governments place greater emphasis on domestic manufacturing, energy security, and technological competitiveness, the strategic importance of industrial metals naturally increases alongside their investment appeal. Financial stability represents another potential motivation. Modern financial markets are deeply interconnected. Banks, hedge funds, institutional investors, pension funds, commodity producers, refiners, manufacturers, and international investors all interact through complex financial instruments. During periods of market stress, maintaining orderly trading becomes essential. Government agencies routinely monitor markets for signs of excessive volatility, liquidity shortages, or systemic risk, not because they seek to determine prices directly, but because disruptions can spread quickly across the broader financial system. Geopolitical developments further reinforce the importance of strategic resources. International sanctions, trade disputes, regional conflicts, and supply chain disruptions can all influence commodity markets. Precious metals often receive increased attention during periods of geopolitical uncertainty because investors tend to favor assets perceived as independent of political promises or corporate liabilities. Governments likewise evaluate how strategic resources contribute to national resilience during unpredictable global events. Another important consideration is public confidence. Financial systems operate largely on trust. Banks depend on depositor confidence. Bond markets depend on investor confidence. Currency systems depend on public confidence. Even stock markets ultimately rely on confidence that economic institutions will continue functioning effectively. Precious metals often become more attractive when that confidence weakens. As a result, policymakers naturally monitor developments in gold and silver markets because they can provide valuable signals about investor sentiment. It's also important to distinguish between monitoring markets and controlling them. Governments around the world routinely oversee financial markets through regulatory agencies responsible for maintaining transparency, enforcing trading rules, reducing fraud, and protecting market integrity. Oversight is a standard feature of modern financial systems and should not automatically be interpreted as evidence of direct market control. Discussions about expanded government involvement often combine documented regulatory responsibilities with broader speculation, making it essential to separate confirmed information from interpretation. Technology and market structure also continue evolving. Electronic trading allows enormous volumes of transactions to occur within fractions of a second. Algorithmic trading, high-frequency strategies, and global capital flows have transformed commodity markets over the past several decades. These changes require regulators and policymakers to continually adapt their oversight frameworks to ensure markets remain efficient and resilient during periods of extreme volatility. Long-term investors often focus less on day-to-day market movements and more on underlying economic trends. Debt levels, fiscal policy, monetary expansion, demographic changes, productivity growth, energy availability, and geopolitical stability all shape the long-term outlook for precious metals. Temporary price fluctuations may capture headlines, but structural economic forces generally exert the greatest influence over decades rather than days. Perhaps the most important lesson is that precious metals occupy a unique position within the financial system. They are simultaneously commodities, monetary assets, portfolio diversifiers, and historical stores of value. That combination ensures they remain relevant whenever governments, investors, or institutions evaluate economic resilience under changing conditions. Ultimately, any discussion about greater government interest in gold and silver markets should be approached with careful analysis rather than assumptions. Governments have legitimate reasons to monitor strategically important markets, particularly during periods of elevated debt, inflation concerns, geopolitical uncertainty, and financial volatility. At the same time, claims of expanded control require credible evidence and should be distinguished from speculation. For investors, the real takeaway is not to focus solely on headlines, but to understand the broader economic forces that have made gold and silver important throughout history. Markets evolve, policies change, and financial systems adapt, but tangible assets have consistently remained part of the conversation. Whenever questions arise about long-term stability and preserving wealth, every major shift in financial markets creates two very different reactions. One group sees uncertainty and moves to the sidelines. The other sees opportunity and begins asking what the next 5 or 10 years might look like instead of worrying about tomorrow morning's price action. That distinction has separated successful precious metals investors from emotional traders for generations. Gold and silver have never rewarded impatience. They reward preparation, discipline, and an understanding that real wealth is measured over cycles, not headlines. If developments surrounding the precious metals market were to increase uncertainty, the first impact would almost certainly be on investor psychology. Markets don't move solely because of supply and demand. They move because of expectations. If investors begin believing that the financial landscape is changing, capital starts repositioning itself long before the full picture becomes clear. We've seen this pattern repeatedly throughout history. Whether the catalyst was inflation, banking stress, geopolitical conflict, or changes in monetary policy, investors generally respond first to perceived risk and only later to confirmed outcomes. Gold has traditionally benefited during periods when confidence weakens. That doesn't mean it rises every single time uncertainty appears. Markets are far more complicated than that. Short-term price movements are influenced by interest rates, currency strength, liquidity conditions, and institutional positioning. But over longer periods, gold has consistently demonstrated its ability to preserve purchasing power. When confidence in paper assets becomes strained, silver tends to tell a more dramatic story. It shares many of gold's monetary characteristics, yet it also serves as an essential industrial metal. That combination creates opportunities, but it also creates volatility. Silver often experiences larger percentage moves than gold in both directions. When investment demand increases while industrial consumption remains strong, the available supply can tighten quickly. Conversely, during economic slowdowns, concerns about manufacturing demand may temporarily pressure prices even if investment interest remains healthy. This dual personality is one reason many experienced precious metals investors devote significant attention to silver. It has historically demonstrated the potential for powerful advances during precious metals bull markets, but those gains have often been accompanied by equally sharp corrections. Investors who understand this characteristic are generally less surprised by volatility because they recognize it as part of silver's historical behavior rather than evidence that the long-term thesis has failed. Another consideration involves the distinction between paper exposure and physical ownership. Exchange-traded products, mining shares, futures contracts, and physical bullion all provide exposure to precious metals, but they carry different characteristics and risks. Paper instruments offer liquidity and convenience. Physical bullion offers direct ownership without dependence on another party's financial obligations. Many long-term investors choose to hold physical metal as a form of financial insurance while using paper investments to pursue additional growth opportunities. Market liquidity also deserves attention. During periods of financial stress, investors sometimes discover that assets they assumed would always trade smoothly become less liquid than expected. Physical bullion markets have experienced temporary shortages, increased premiums, and delivery delays during previous periods of exceptionally strong demand. These conditions do not necessarily reflect shortages of metal itself, but rather temporary imbalances between immediate retail demand and available distribution capacity. Investors who understand these dynamics are less likely to react emotionally when premiums fluctuate. One factor frequently overlooked is the growing role of central banks. While individual investors often focus on daily price charts, central banks typically make decisions based on decades rather than months. Their